Left-wing party Syriza won the Greek elections yesterday as the nation rejected the harsh economics of austerity. Peter Little from Anchor Capital joins us now for more. Peter, thanks so much. Take us back. Why was this such an important vote for the Greek? And what happened? How did we get to this point?
Yeah, thanks for having me. So I think this is kind of a throwback to 2011, 2012, the start of the euro era debt crisis, and people were reminded that the same thing happened last time. It was Greece that kicked the whole thing off last time. So it's we're back where we were a few years ago and trying to figure out, are the same implications there for the European markets? Syriza, who were expected to win the elections and did so, I think the only surprise was that they won by quite a bigger margin than people were expecting. So they got really close to actually an outright majority without forming a coalition. I think they'll end up with about 149 seats, which is too short of the 151 they would have needed to govern outright. So the surprise is not in that they won. The surprise is that how close they got and how much more of a mandate they'll potentially have to negotiate their debt with Europe now.
Of course, as Kobe was saying earlier, it's one thing to be in opposition and say what has to be done. When you're actually in the hot seat, are they the equivalent in Greece of the economic freedom fighters? Lots of noise, but no experience of office. What's actually going to happen now?
Yeah, I don't know that they're necessarily the equivalent of the economic freedom fighters, although the party that ended up in third, the Golden Dawn Party, is probably the equivalent of that. And that was another surprise. They came in with about 6.5% of the votes, and they're certainly a fairly extreme views on things. But Syriza, Alex Tsipras, who's the leader of Syriza, he's only 40 now. So he came to prominence, obviously, when Syriza was trying to push for votes in the last elections in 2012. So he's a reasonably inexperienced, very young guy. And I think he's got his hands full. The noises out of Europe are certainly that they're not going to be a pushover. They're saying, don't think you're going to come and renegotiate all these dirt terms and still expect to get the bailout money from us. So I think he has his hands full. He has toned down his rhetoric a lot since the previous elections. So in the previous elections, he was very much talking about, we want out of the euro, Greece needs to govern itself. This time he understands that I think about 75% of Greeks actually want to stay in the euro. So it would have been political suicide for him to come out with that sort of fighting talk. So he's toned down the rhetoric a bit this time, but he's still talking about a sort of 50% cut in the debt that he wants to pay back to the European officials. So he's got his hands full.
So what now? We've already seen some nervousness setting in the Asian markets. Is this something we can expect to happen going forward? More uncertainty, more volatility?
Yeah, I think so. So these election results will have done nothing to calm the markets. In fact, quite the contrary. It's actually got a lot closer than they think. And as I say, this guy has now probably a bigger mandate than we initially thought he would have. So it's very much a wait and see. We need to see how his negotiations start with the euro. I think ultimately the big fears that the market has, I mean, Greece itself is 2% of European GDP, so I think people are less concerned about what actually happens in Greece, but it's the contagion effect. And I think the difference this time is that last time we had this scenario in 2011, 2012, the Greek debt was by and large held by the private sector, so I think roughly 60% of Greek debt was held by the private sector. This time, very different scenario. The debt's largely held by officials. I think 75% of the debt is with government-type entities. And so the knock-on effects are significantly less this time. But the thing that people will be watching for is if the Europeans get tired of the Greeks and say, you're out, we can't deal with this anymore. That has implications for all of the other peripherals. So now you no longer look at Spain's debt and think, I'm actually taking on European debt. Now you have to look at Spain in isolation because of the impact that potentially somewhere down the line it could be.
But what are they going to do differently? I mean, one of the stats that came out again is that 175% of GDP, that's the level of their debt, second only to Japan. Yeah. Now, there was a lot of tough talking with the old government for the austerity. Yeah. Now, a new government comes in, they're not going to be a whole lot of nice new conditions. That'll also set a precedent for anyone else who's got heavy debt.
Yeah, exactly. They definitely don't want to create a situation where Italy and Portugal and everybody else is coming to renegotiate their debt. So they have to face a pretty hard line. I think the level is absolutely worrying. 175% is a scary number. What's slightly different this time is obviously the interest cost on that is a hell of a lot lower. So they've managed to bring down the interest cost significantly, push out the maturity. So the actual sort of interest burden is not as tough as it was last time. And yeah, it's certainly a worrying number. What Tsipras is saying he wants to do is have the official holdings, so the non-public holdings of Greek debt cut in half. I think that's absolutely not going to happen. You can't have that and stay in the euro. So what can potentially happen is we push the maturities out again, potentially bring the interest rates down again. I think that's what the European Union will certainly be pushing for.
Oh, thank you so much for your analysis. That was Peter Little. He's from Anchor Capital.